Welcome to Markets Now. I'm Michelle Rook along with Ted Seifert, Zaner Ag Hedge, and mostly higher as far as the trade today, with the exception of the hog market. And we got a little short covering here, kind of ahead of the reports and the grains, didn't we, Ted?
Yeah, really did. And to be expected, I suppose, Michelle. I mean, you look at the last 2.5, 3 weeks, and it's been mostly down in the grain complex. So for some shoring up and some short covering of positions in front of a big WASDE report, to be expected. We also had help from export sales, but this WASDE report is a fairly important one. Don't sleep on that. Obviously, we're going to be looking at yield first. That's the first thing that we'll look at. And then we'll see how that trickles down through the balance sheet, what our ending stocks are, so on and so forth. But again, I think the market really respects that, which is why we've spent most of the week, with the exception of Monday, really trading sideways, treading water, and seeing some of that short covering and position shoring up before the big number.
So the average trade guess has a cut in yield on both corn and soybeans, but there's other people saying that USDA might punt on this report on yield, but can they do that?
Actually, no, Michelle, they really can't punt on this report. And the reason for that is because the way they calculate yield on this report is different than any other report we've seen so far this year. Every other report that we've seen, starting with the Outlook Forum back in February, these are all statistically based numbers, and it's a statistical model of trendline yield versus the weather that we've had. This, in the August report, is now an objective yield. It is a farmer survey combined with satellite imagery. Now, we don't know exactly the percentage that each one of those are weighted. We have been told that the farmer survey is the one that they look at first. Either way, this is an objective yield. It's not just the pencil pushers, right? So it's possible that the objective yield is close to the statistically based one. Maybe the stats were really right on. That's possible. But there's also a world that exists where this could be a big shock in one way or the other. And I'm also very curious, and they won't tell you, but I'm also very curious how much they're going to use the satellite imagery on this report, because since that survey took place, there's been a lot of really favorable weather. And I think if we redid that survey today, you might have some more optimistic answers from a lot of your producers. I think the USDA, if they look at the satellite imagery and how it's changed since that survey occurred, might be able to figure that one out and may apply that. So, I'm very, very curious to see what this yield has to say. There is the potential for a big surprise. But this objective yield is going forward. This is the real deal, right? It's not just the stats number. And then in September, they added their own yield plots, their test plots. So there's an even further addition to this objective yield. And from here on out, it's just going to get tighter and tighter to what the reality is, not just a guess.
So do we have a yield cut kind of already baked into prices? So if we do have yield go the other way, it could be wildly bearish to price, or what?
Yeah, I mean, if you look at the analyst guesses, 175.5 for corn, and what is it, a 51.3 or 51.4, depending on which survey you follow. I think the market might actually be looking for bigger cuts than that. In fact, I kind of think if the analysts' guesses are right, I think that's a bearish report, unfortunately. So we'll have to see. But yes, there is absolutely an expectation for yield cuts. If you don't get that, if the USDA finds yields, if their objective survey finds yields that were similar to what we saw in the July forecast, oh boy, that's going to be really rather bearish for the markets. And it would come at a very bad time, because you have really all three, corn, wheat, soybeans, all holding on to some very key support levels at the moment. And you're going to need a friendly report, I think, in order to hold them. Now, wheat's not going to be dependent on its yield. I mean, we've got a pretty darn good idea of what the yield, what the wheat numbers are. But yield, I think, to some extent, will be a follower to the row crops if there's any big surprises there.
Hey, we haven't even talked about demand. What kind of demand adjustments do you anticipate?
It's not the time of year for that, Michelle. Everybody wants to be so focused on yield and weather and the production side of things. Unfortunately, we'll get back to talking about the demand side of the equation at some point in the very relatively near future. And that might not be a great conversation. For soybeans, actually not so bad. We saw a really solid export sales week for soybeans, 1.5 million metric tons combined between old and new, mostly new. And it's the time of year to see that. It occurs to me, Michelle, in the last 8 years that I've been going on crop tour, I feel like every day that I'm on crop tour, we see a flash sale, usually to China, for soybeans. And this is just our season to be selling new crop beans. And we've been seeing those flash sales, and they add up, and we're getting some good weeks. You had the first halfway decent week for corn, but corn's got a whole lot of catching up to do. And unless it does, you really don't feel very warm and fuzzy about the demand side of the corn balance sheet. And I'm also going to say it's important to note that the USDA has corn demand going up over 800 million bushels from last year to next year, from actually the very tail, this current marketing year, which we're at the very tail end of, to the new crop marketing year. For soybeans, they actually have demand going down. So, I mean, when you look at a soybean balance sheet, it's important to understand there's not a whole lot of fat to trim off the bone on the demand side of the equation. But a corn balance sheet has a lot of demand that could be or maybe should be shaved off, depending on who you ask. So yes, it'll be interesting to see if the USDA does anything on the demand side of the equation. If there is a big change on the yield and the production side, then there will be some changes on the demand. That's just how the USDA works when we're sitting here before the actual start of a marketing year.
Yeah. All right, let's go back. I should ask you this when you were talking about some of these major support areas that we've been holding. What are the numbers that we're looking at? What, the 100-day moving average? Is that what you're using in November beans?
Yeah, so you got your 100 and 200 right there, which we dipped below yesterday on Wednesday, and then we ended up closing back above. That was part of the reason why we found some strength here on Thursday. Again, short covering in front of the report, along with a decent export sales week and a flash sale to China. But it didn't leave you all warm and fuzzy when we closed well off the highs there on Wednesday. And again, you're going to need that bullish report, I think, to get us up and over Thursday's highs and really get us kind of to recover back towards those highs. The unfortunate thing is, if we get through Wednesday's low, if we close below Wednesday's low, oh boy, there's a lot of rather thin trade. When we went higher based on that 4 million acre cut. Well, you got to look at the end of May lows. That 1130 is a big major target, because you would have a very large topping formation in the beans if we break and close below Wednesday's low, which would again tell you you're closing below that 100-day moving average. You really don't want to see that happen.
No doubt. And what about corn? December, the July low is at 481. Is that kind of a demarcation line there or not?
It's a huge line in the sand. Right now, you've got a consolidation bear flag happening in the corn market. You can wipe that off the chart with a really solid, if we can close 20 cents higher, not necessarily on a report day, I'm just saying if we can somehow get 20 cents higher and close there over the course of the next 3 sessions or so, you can take that off the chart. But until that happens, you have to worry that 480 is going to fall. And then you start looking at a harvest low of around 430.
CPI out this morning, a little bit better than expected, but what do you think going forward here? Because is the Fed still kind of on their crash course to continue to raise rates?
Most people had been expecting a pause in the September meeting. The good news is that they've got a little bit more time to think about this one, right? It's not. There's no August meeting. That CPI number kind of changed that.
Right.
You saw the Fed funds number or the Fed funds market, as well as I'm going to say the gold and the silver markets, really kind of price in the possibility now of another rate hike in September. Which again, that's not what the market had been thinking just a week or two ago, or even just a couple of days ago. Most people have been expecting that this is it for the Fed. They're going to pause. Maybe even some people suggesting that we could see cuts before the end of the year, even though the Fed has said multiple times that's not going to happen. This sort of changes that. Inflation is rearing its head again. It's stronger than they want it. We know that. And I'm going to argue that when we look at these inflation numbers, they're retrospective. They're not a very good snapshot of where we are here today, because a consumer price index, think about that. These are prices that we're paying for finished products. The inputs that go into those finished products were bought and maybe even hedged a very long time ago. So again, inflation is a lingering thing, and CPI is one of those things that is the worst when you think about lingering inflation. So I don't know what the Fed does. I kind of have been a proponent of them continuing to raise rates. This might give them some fuel to do that, along with jobs reports continuing to look good. I mean, there isn't anything saying that they can't. Aside from that, it's been a very dramatic rise in rates in a fairly short period of time. So again, pumping the brakes is what most people have been suggesting or hoping for. But now they have, again, they have reason to really think about it a little harder than maybe they did, Wednesday.
Yeah. All right. Let's finish on cattle markets and talk just a little bit about the fact that this market's held together pretty well, considering the seasonals usually roll over. How encouraged are you by that?
Yeah, there's been a lot of analysts that have been looking for lower cattle prices. And again, a lot of it's seasonality. And yeah, we expect seasonality to happen. But for the fact that we haven't rolled over to the downside is fairly encouraging, I would say. And even on a day where corn, albeit not sharply higher, was higher, you had feeder cattle higher as well, bouncing off a key support. So far, so good. We keep testing this trend line in cattle. You keep thinking, oh, now this is going to be the day where we break through and we start on this bigger correction, and then we turn around and bounce. I will say that although we did bounce off of it here on Thursday, we weren't able to close up near our highs, so you didn't have that real warm and fuzzy feeling by the end of the day, and you worry that we might try this again tomorrow. But again, seasonality should have taken hold 2-3 weeks ago, and it hasn't so far. Even box beef prices, while they have softened a little bit, you have some up days in there too. And cash cattle stayed fairly constant. So I don't know if the seasonality is going to happen. It's going to happen rather soon. I think we'll know in the next I think we'll know by the end of the week, Michelle. Because again, we are at a fairly precarious position on the charts, really kind of clinging on to some support on that trend line. And there are going to be some analysts that say that you have a very large bear flagging top in the live cattle right now. But let's get to the bigger picture. If we were to have a breakout to the downside, I really do feel like this is a corrective in nature, sort of seasonal play. I really think by the time we get into the fall, unless you have a dramatic change in the economy and people's spending habits, the bullish fundamentals are still there. And it's going to take a long time to fix that. A dip would be a correction in my book. I don't think this is an overall change in trend or a long-term top of the market, at least not from what I see in front of me today.
Yeah. And we've had 4 key reversals that we've negated. And in this kind of an environment, fundamentals may win over the technicals. So, all right. Thanks for joining us. It's Efred Zaner, Ag Hedge. That is Markets Now.